May 6, 2010, 2:32 p.m. Wall Street calm. Screens mostly green. Volume steady. By 2:45 p.m., nearly $1 trillion in market value vanished in minutes. Blue-chip stocks dived. The Dow dropped nearly 1,000 points. Some large companies briefly traded for pennies. Traders shouted. Algorithms spun. Liquidity froze. The event has a name now: the flash crash. The technical reviews that followed treated it as a puzzle of modern markets. Fragmentation, speed, and automated trading interacting in ways regulators had not fully anticipated. But the public story that followed took a different shape. Years of investigations narrowed focus to one actor who did not sit in a Manhattan trading room. He worked from a suburban house in West London. No big firm, no trading desk, just a bedroom, 6 monitors, and software he built to push the market. This is the story of how a single individual used orders, timing, and machine behavior to turn speed into a weapon, and how his actions exposed fault lines in a market built on automation. Navinder Singh Sarao grew up ordinary. He was not a career insider. He had no hedge fund, no big capital, no teams. He lived in Hounslow, a suburban borough in West London. Neighbors described a quiet house, modest, curtains often closed. He was private and solitary. After the 2008 financial crisis, he watched banks that had made large bets get government support, while many people suffered losses and lost jobs. He came to distrust the system. That distrust hardened into a plan. If markets were driven by machines, machines could be tricked. If the big players used speed and order books to read intent, then the order book itself might be manipulated to create a profitable illusion. He focused on the E-mini S&P 500 futures, a highly liquid, widely followed contract traded in Chicago. Those contracts are central to electronic price discovery. Modern trading systems watch depth, flow, and order placement in microscopic time frames. On those dimensions, a well-timed pattern of orders can move the price enough to create profit opportunities if you are on the right side of the move. Sarao's toolset was not mysterious. It was conceptually simple and technically precise. The method goes like this. Place large sell orders on the sell side of the order book, far bigger than what the market expects. Those large orders create an apparent wall of supply. Algorithms and other market participants read that wall as real selling pressure. Many automated systems respond by selling into the weakness or by moving their own orders. As prices drop in response, the manipulator removes the fake sell orders and buys at the new lower prices. Once positions are acquired, the manipulator then allows the market to recover and sells for a profit. This technique is called spoofing, and in more elaborate forms, layering or dynamic layering. It relies on one core assumption. Modern market participants, especially automated ones, treat visible order book depth as genuine information about supply and demand. The manipulator's software places and cancels orders thousands of times per day, sometimes hundreds of modifications per second. The effect is to feed algorithms a false picture of market intent. Regulators and prosecutors later described Sarao's program as placing thousands of orders, canceling most, and timing executions to exploit the automated responses of other systems. Picture the order book as a ladder. Buyers climb from the bottom, sellers stack from the top. Sarao created artificial rungs on that ladder, massive sell orders stacked above the market. The machines saw the weight of those rungs and reacted, sometimes by selling into perceived pressure, or by widening spreads to avoid being picked off. He automated the process. Custom scripts placed multiple levels of sell orders, not just one big order, but a curtain of them, and continually adjusted their location as the market moved. If the market dipped, the software nudged orders to follow the price, keeping the illusion intact. At the points where actual fills occurred, small, real trades happened, but the much larger volumes of placed orders were canceled before execution. In short, a tiny number of fills, a huge number of fake placements. To the machines on the other side of the globe, that look of depth translated into action. Automated liquidity providers and high-frequency strategies sold first and fast. Price fell. The manipulator bought. He canceled the fake supply. Prices bounced. Profit realized. Over time, and across thousands of instances, the net result was large gains. Prosecutors later estimated the cumulative gains over several years at tens of millions of dollars. Markets that day were already fragile. Global news and sovereign debt concerns had created headwinds. Structural factors, fragmentation of trading across venues, the rise of electronified markets, and an ecosystem of algorithms had already altered how prices moved. Into that setting came a sudden, intense wave of selling in E-mini futures. The selling behavior interacted with multiple automated strategies, causing a cascade. What Sarao did that day, according to US authorities, was to run a particularly large, dynamic series of sell orders in the E-mini marketplace. The orders were numerous and layered. Many were canceled rather than executed. The combination of those placements and their interaction with other high-speed strategies and liquidity providers contributed to the sharp, rapid decline in a compressed time window. Stocks in the New York markets, which use futures for price discovery and hedging, responded in turn. The Dow's nearly 1,000-point plunge reflected a cross-market feedback loop that began in the futures market and spread into cash equities. The official post-event reports from US regulators later described the flash crash as the product of complex interactions among many participants, with several structural contributors. Still, the trading patterns traced to a single trader were a clear and striking component of the day's events. Investigators from US agencies and exchanges examined trade records and order logs. The pattern they saw was not the random noise typical of retail traders. It was deliberate layering. Large numbers of orders on one side of the book, often canceled within seconds, combined with smaller orders on the opposite side, intended to execute if the market moved. The volume of modifications was remarkable. According to regulatory filings and the CFTC's consent order, the dynamic layering program used by Sarao placed large blocks of orders over prolonged periods and modified them tens of thousands of times, with only a tiny portion executed. The orders created the appearance of persistent selling pressure while leaving few executed trades in their wake. That pattern fits precisely the technical definition of spoofing, entering orders with the intent to cancel them to create artificial market signals. For years, international regulators and exchanges debated the root causes of the flash crash. The U.S. Commodity Futures Trading Commission, CFTC, and the Securities and Exchange Commission, SEC, published joint staff reports that pointed to structural vulnerabilities, including the way algorithms can feed on each other and the ways fragmented trading venues respond to intense flow. Those reports did not single out one person as the sole cause, but subsequent analysis of consolidated order data and trade logs showed consistent, repeated spoofing and layering by a particular account. That account's orders were large, placed strategically, and canceled heavily, a fingerprint that allowed investigators to follow traces across systems. Using IP logs, exchange records, and account trails, investigators located the activity back to an individual operating from the UK. In 2015, following long investigative work, US authorities moved to charge him. The Department of Justice indicted him on multiple counts, including commodities fraud, wire fraud, and spoofing. The US case framed the behavior not merely as novel trading, but as deliberate manipulation. Public reporting around the case cited substantial alleged gains. Authorities estimated cumulative profits in the tens of millions of dollars over several years. Different outlets reported figures in the ballpark of $40 million as the amount U.S. agencies associated with the traders' gains, though not all of that total was necessarily attributable to the spoofing counts tied to the flash crash itself. Press coverage and charges described both long-running profits from the layered strategies and specific gains from the May 6th episode. Those figures helped explain the gravity of the indictment and attracted widespread attention. When authorities moved, charges crossed borders. He was arrested in the UK in 2015. The US sought extradition. The legal process in Britain addressed questions of dual criminality and the nature of the conduct alleged. A public judicial record in the UK shows the extradition proceedings and the arguments made in defense. While the process wound through courts, the trader was released on bail under strict conditions, including limits on internet access and regular reporting, while fighting the US request. Eventually, he was extradited, and in 2016 pleaded guilty in US federal court to charges that included 1 count of spoofing and 1 count of wire fraud, among other allegations. The guilty plea acknowledged the use of automated trading programs and the practice of placing orders without intent to execute those orders, with the intent to manipulate. The plea and the broad evidence presented by prosecutors crystallized the case in U.S. courts. The narrative of a lone trader crashing the market was powerful. It fit a dramatic image, a single person in a quiet house, outsmarting complex systems. Journalists seized the angle. Political and regulatory debates used the case to highlight the need for better oversight, clearer rules, and stronger deterrence. For many observers, the story put a human face on problems that otherwise risked being dismissed as technical or remote. But analysts and some market participants also pushed back. Was the trader a villain who single-handedly wrecked markets? Or was he a revealing symptom? A person who showed how fragile an architecture built on automated reaction can be when multiple participants act on the same signals. Most technical reviews landed on a mixed view. The trader's activity contributed materially to dislocations, but the flash crash was the result of multiple interacting causes, including legitimate orders, algorithmic responses, and the withdrawal of liquidity by many providers simultaneously. After pleading guilty, he did something important for the prosecution. He cooperated. According to public court filings and reporting, his cooperation included explanations of his methods and assistance to authorities in understanding spoofing and layering tactics. Prosecutors highlighted his cooperation as mitigating. In January 2020, U.S. sentencing concluded with a lenient outcome relative to the maximum sentences possible under the charged counts: a period of home confinement rather than extended prison time, and forfeiture of sums tied to gains. Coverage of the sentence noted both the substantial alleged profits and the role his cooperation played in the sentencing recommendation. That resolution surprised some observers. The contrast between the spectacular financial disruption he helped cause and the final sentence prompted debate about proportionality, the value of cooperation, and whether legal outcomes in complex market cases should hinge on the defendant's background and mitigation factors. If there is a single practical lesson from this story, it is this. In markets driven by automated decision models, the visible inputs to those models become targets. Order books are information. When algorithms make trading decisions based on observable order book depth and flow, those observables can be gamed. The structural risk is not just that one actor can profit illicitly. It is that the mechanisms of price discovery become brittle when many actors use similar cues to make rapid decisions. Regulators responded. The CFTC and SEC pursued enforcement for spoofing. Rules were clarified and penalties for manipulative practices were strengthened. Market venues implemented protections, kill switches, surveillance tools, and limits to detect and block suspicious layering behavior. Exchanges and trading firms also refined algorithms to be less vulnerable to simple depth-based deception, or to flag when a counterparty places and cancels orders at a scale inconsistent with normal intent. The case catalyzed a wave of conversations about automated market abuse and how to craft both technical and legal responses. It is tempting to want a single answer, a single villain. The case offers that. A person who placed fake orders and profited from machines that took the bait. But that single answer is incomplete. The market meltdowns reflected interactions among thousands of actors, many of them automated, and the architecture then in place amplified reaction rather than absorbing it. Saying that a bedroom trader crashed $1 trillion of market value simplifies a more complex truth. His activity was a trigger that revealed systemic fragility. He did not create the machinery of electronic trading. He exploited it. When the signal he generated met systems that were designed to trade on short-term cues, the cascade followed. That distinction matters for policy. If enforcement focuses only on individuals, the architecture may remain vulnerable. If regulation focuses only on structure, without effective deterrence and clear legal definitions, manipulators will adapt. The Sarao case sits at the intersection of enforcement and system design. It shows that both matter. And that's the story of the bedroom trader who shook Wall Street. If you found this video eye-opening, hit that like button, subscribe for more deep dives into the world's biggest financial stories, and don't forget to ring the bell so you never miss an update. Drop a comment below. We'd love to hear what you think about this crazy market saga.